Good morning, everybody. Thank you for joining us this morning for a new venture that we're trying within the South Carolina Angel Network. Welcome to our first ever crowdcast. For those of you who don't know me, my name is Paul Clark. I'm one of the managing directors of the South Carolina Angel Network. We are an affiliation of angel investment groups that run from Asheville in North Carolina down to the coast of South Carolina. We have about 250 people that are investors in our group. And one of the things that we like to try to do is educate and provide resources for entrepreneurs and investors to become involved in early stage financing of companies. One of the ways we do that is through our 501c3 nonprofit called Venture Carolina. And this is a Venture Carolina quick Q&A workshop to help you get a few tips on how to pitch to angel groups like ours and to investors more generally when you're raising money for your business. We're doing this for the first time on the Crowder.tv platform, and this is a new portfolio company of our SCAN organization and a Charleston-based technology company that allows both live streaming, so I'm doing this to you now live, and a Q&A function, as well as a crowdfunding fundraising aspect to the platform. This is the first time we've used it, so thank you all for testing this out for the first time, and I hope it goes well. The main point of this broadcast is really to give you a forum to ask me questions, to address the questions you might have on ways that you can improve your ability to get funded from groups like ours. I do have a few slides that I'm going to very quickly run through, but for the most part, we're going to do this through Q&A. And just to give you a quick rundown of the platform that you see in front of you, which for I think everybody on the call, this is the first time you've seen a platform that does exactly this. At the bottom, there's a green button that allows you to contribute. You absolutely do not have to do that for this if you don't want to. There's no obligation to participate. If you do, it's a contribution to Venture Carolina, which is a tax-deductible charitable contribution, and we'll use that to do similar educational and resource creation for early-stage entrepreneurs and investors. But there's no obligation for you guys to find any value in this workshop at all, so you do not need to contribute if you do not want to. On the right-hand side, though, I would ask you if you have questions, please submit questions to that forum, and I'll do my best to address them as part of this conversation. You can upvote other people's questions if you like what you see, and I'll try to answer the most popular questions from the group. You need to be logged in through Facebook in order to submit a question, so if you would like to do that, you're welcome to. You can also watch this again later. Once the live broadcast is finished, then the recorded version will appear on both the Crowder website and our SCAN website, which is www.scangelnetwork.com. So you can review this afterwards if you like as well, and go back and delve a bit further into some of the tips we're talking about. So with that introduction, I would ask you again, please feel free to submit questions along the way about whatever comes to mind, either based on the material or questions you already have outside of the material, and then we'll get started. For those of you that want to follow along with any slides, if you go to the front page of our website, in the events section, there's a link to a very short deck that has a few tips that we're going to talk about today. So if you want to follow along with that, you can too. The first basic piece of advice that we'd like to give people is very simply to know the audience that you're talking to. When you're pitching to any kind of investor, it's obviously crucial to know exactly what things they're interested in and what things they're not. If your business is based in California, if you're raising money for a real estate fund, if you're raising money for a high street or main street business, if you're raising $5 million of venture capital money, if you're raising all of these things that we don't do in our angel group, then we're not a good place for you to go and speak to. And likewise, if you are looking for angel funding like ours, go to us, not to other sources of capital that you're going to waste your time talking to. It sounds obvious, but 2/3 of the businesses that come to our group over time haven't fit the criteria that we make pretty public about what we would like to invest in. So you're wasting your time and ours by providing or by trying to connect with us and asking us for funding for businesses that we just don't participate with. So know generally the investor group that you're talking to and what their interests are. And then even more specifically, there's a lot of variation between angel groups, between different VC funds, and between individual investors when you go and talk to them. Everybody has different backgrounds and interests, companies that they've invested in and lost money in the past, companies they've invested in and made money in the past. So if you can get a better sense for more detail on what kinds of businesses that particular group is likely to want to fund in the future, that gives you a much better chance again of finding the best groups for you to spend time with. For example, just if you wanted to pitch to our group, spend a couple of minutes looking through our portfolio, and if you see no companies in there that are drug development companies, for example, like yours, we're obviously not going to be a great fit for a long payoff investment like that. If you're a high street barbecue joint, for example, you won't see any of those on our website, and you won't therefore get funded probably. So don't waste your time talking to us. So very, very simple advice: pick your investors wisely that fit with what you're trying to do, and then spend all of your resources on trying to engage with them, not with people who are ultimately not going to be interested in funding you. All investors, as I say, are different. Make sure you align the return goals that you're outlining for your business with that investor's return goals. So ours, for example, is a 3 to 5 year return, trying to earn 10 times the return on our invested capital. If your business is more like an 8% debt return type situation, then again, we're not going to be interested in that, and you're going to waste your time if you're trying to get hold of us to talk about that. So that's the basic piece of advice to begin with. I'm not going to talk about everything that we typically talk about in our full 2-hour workshop that we run on how to pitch to angel investors, but I'm going to hit a couple of the highlights so that we have some things to talk about. At some point during your presentation of your company, you're going to have to pitch in a formal environment to one or a bunch of potential investors, and your pitch deck is going to be a crucial piece of your armory when you're engaging in a fundraising process. There are countless resources out there for good advice on how to do a good pitch deck, and we're not going to go into too much of that. But if you're following along on the slides, then you might see that we have a 10-slide template that we like to see, and there are lots of other great resources out there that can provide you with other advice. The main reason for hammering on about this isn't so much that there's a predetermined template that you have to use to do a good pitch. It's that most companies that pitch to us do not give us the information we need to make a good judgment on whether or not this is a business we want to spend time in. And the reason they fail on that is they spend all of their time, or 80% of the time during their presentation, talking about what the business actually does in terms of product or service, and doesn't spend any time, or at most 20% of the time, on the other 9 things that we're interested in: deal structure, financial projections, the background of the management team, how exactly the company makes money. All of those things always get a second rating from the entrepreneur, but they're actually, to the investors, more important oftentimes than what the business actually does at a very detailed level. So as you construct your pitch deck, perhaps you should construct your pitch deck to encourage the presentation to include those items that are important to investors, that are not necessarily so obviously important to the entrepreneur. So that's one piece of advice. In terms of structure and style, we see a lot of very poor presentations, and that's one of the saddest parts of what we do when we find an idea that we really like presented to us or to the angels in our groups in a mediocre or unimpressive way and don't get funding, when the actual underlying idea is pretty good. And a lot of that is avoidable just from preparation and following some very basic advice that most people ignore or forget, or don't take the time to go and research to figure it out. So it's a few basic pointers on style. Don't have large blocks of text. Use bullet points. Make the slides as simple to follow as possible. Attractive if it can be, but attractive slides don't necessarily save a pitch that has poor content. Lead with the point. That's one of the biggest failings of most presentations. Don't tell you up front clearly what the point of that particular slide or that subject area is. And if we have to try and deduce that from a lot of prose on the slide, then that becomes very hard for us to follow. In terms of presentation, every company that we see, almost every company that we see, reads aloud at least some of the slides that they have on the screen. I was at a pitch yesterday where the presenter literally read bullet points and in some cases full prose sentences to a group of individuals, which is a waste of time for them, waste of time for us because we'd already read the slides, and didn't give them a good chance to pitch their business to us because they did that presentation part poorly. So some of that basic advice, again, we say it to everybody all the time and most people ignore us, but you don't have to be that great at presenting to stand out from a number of companies that present poorly. One question we often get asked is who should do the presentation? our default answer to that always is the CEO should do the presentation. And the reason for that is it's the CEO's job to sell the company to everybody during the life of the company, to investors when they're trying to raise money, to customers when they're trying to sell a product, to acquirers when they're trying to sell the company, to newspapers when they're trying to get good publicity for the company. And if the CEO is incapable of doing that first presentation to investors, then it's not a company that we are going to want to fund. So if the CEO is not the one doing the presentation to us at the beginning, we're going to have some pretty penetrating questions about why that's the case. So that's one part about who should present. How should they present? Again, the biggest piece of advice we have for people is practice. If you're giving a pitch for the first time to a group of investors, you need to have practiced it a dozen times to yourself, to your friends and family, to Crowder with nobody watching in some cases, and film yourself, watch how you pitch, how you give your presentation, and criticize yourself thoroughly and make sure you do better the next time. First impressions during presentations matter. A lot of people make their decisions in everything in life in the first 5 seconds, right? And that's true as well for a lot of people hearing formal pitches for the first time. So if your practice and those first few minutes of your presentation are excellent, then you stand a much better chance of being funded than if they're not. And then lastly, the last area that I wanted to talk about, and it's partly the reason for doing this workshop in this way, is that one of the biggest areas that companies fail is on the Q&A part of their presentation. In the formal pitching process that we have in our group, we say to companies, you have 30 minutes to pitch to us. We typically advise you to take 15 minutes to do a formal Q&A, a formal pitching part, like this monologue you're hearing from me now, and then leave 15 minutes for Q&A so that the investors in the group can ask the questions that they want answers to in order to make a decision. And almost always the company ignores that advice and takes 25 minutes to do the pitch and leaves 5 minutes for some rushed Q&A, which is a big mistake, but everybody does it. And even if they do leave some time for some good Q&A, the way they handle Q&A is typically very poor relative to the quality of their presentation. And again, this comes down to preparation and practice. Q&A is very important. So I think it's probably the only word that's bolded in my slides. We can't emphasize that part enough. Companies that present a scripted pitch well are great. That's a great start. But then if you lose it on the 10 minutes of unstructured Q&A because you're not well prepared, then that's really disappointing for everyone. And actually the Q&A is a great time for you to be able to prove that you can shine, that you know the business, that you're adaptable, that you can respond to criticism or suggestions in a constructive way. So don't neglect that when you're preparing your pitch process for investors. A couple of places that specifically people fail on the Q&A part is not giving straight answers. When you're asked a question by an investor, that isn't just an opportunity to talk for 5 minutes about something that comes to mind. If you can't answer a question that the investor's asked you in 15 to 30 seconds total, then you've really messed up the answer to that question. If it's a yes or no type question, answer it yes or no at the beginning. If it's a more discursive question, give a straight 1 sentence or 2 answer. And then if you need to add some nuance later, then you can do that. But make sure the concrete answer to the question is given right at the beginning of the question. Now, I'm going to try and do that to the questions that you guys asked me during the course of this presentation. I'll probably fail, but that's the idea. Try to make sure you answer questions as concisely as you can. And then again, practice. There shouldn't be an occasion where you're giving a pitch to an investor and you're asked a question that you haven't already prepared the answer to. In our groups, you typically pitch in a number of places, so you actually do hear the same question again and again. And when you're talking to a wide variety of investors outside of our group, you're going to get the same questions again. One good thing to do is take a list, note down the questions that you get, go back and look at your answers and make sure next time you answer it in a more concise and more positive way potentially than you answered it the first time. Compile that frequently asked questions list and keep it with you, and practice the Q&A. Have your friends and family ask you questions about the business, and respond to them and see what they think about the questions. So that's my kind of pre-potted advice. I would like to spend some time on the questions. There's a few people on the call, so thank you for doing that. And so you can probably see on the right-hand side the questions that are being submitted. And so I'll take some time to go through those now. If other things have come to mind as you've watched this presentation, then please do throw in some questions and we'll keep this moving along. again, you need to be logged in through Facebook in order to ask a question. So please do that. First question comes from Casey Banks. She asks, how important is one's background? If somebody's never started a company before, would that be viewed as a negative to investors? And there are a couple of ways to approach that. In general, investors like to see entrepreneurs that have done this before. Done this before can often mean has had a positive track record with a startup. And if you've sold your last startup for $100 million, then that obviously gives you a lot more credibility when you're raising funds the second time. But we do back a lot of first-time entrepreneurs or a lot of more experienced entrepreneurs that have had experience in other corporate situations before and are now doing an entrepreneurial venture for the first time. So it wouldn't necessarily be viewed as a negative that you have that somewhat lack of background in the entrepreneurial space, but you certainly need to make sure that you prove that you have the skills or the background or the attitude and aptitude to be a successful entrepreneur, even if you've never actually demonstrated that by being a successful entrepreneur in the past. So we do very much encourage young entrepreneurs. We funded a group of recent college graduates in one of the deals that we did just before the holidays. And if you surround yourself with good advisors and with mentors, and you prove that you're willing to take suggestions from people and advice from mentors and are receptive to conversations with us as investors, then we're pretty likely to back you if we like the other parts of your company as well. My next question, another one from Casey, is how does your group compare to Shark Tank? We compare to Shark Tank at a superficial level, pretty obviously, right? We have entrepreneurs come in and pitch to our group. Our investors provide, I think, more civilized feedback than some of the investors on Shark Tank do. But it's the same kind of process. We want to ask penetrating questions so we understand the business. We want to see how you guys react to that kind of criticism or more detailed, more thorough delving into what you're trying to do to see if you've thought about the questions we're asking. So conceptually, it's fairly similar. It's more hometown than TV. It's not. There's no glamour or Hollywood to it. It's a lot of hitting the building blocks and the basics of presenting your company effectively. But the ultimate outcome is somewhat similar too. If you do a good job in presenting to your investor group, whether that's a Shark Tank TV crowd or a South Carolina group of local investors, you get funded. And if you don't, then you don't. I'm going to move on to the next question now. How much do you guys typically invest? So I'm not sure I went into too much detail about our investment criteria, but you can find those on our website. We lay out exactly what kinds of companies we've invested in. And if you look in our portfolio page, you can see some of the companies we've actually invested in. We typically try to invest somewhere between $250,000 and $750,000 in companies raising that kind of money. We invest equity capital. So we don't do debt, we don't do bridge loans, we don't do quick flips or real estate investing. But somewhere in that $500,000 range is where we try to make our investments. We sometimes take smaller parts of larger rounds. So if you're trying to raise the next round after a typical angel round, and you have a strong lead investor from a VC fund or a family office or some other group of investors, then we might invest a similar amount, 500 or so, in that round as a smaller part of somebody else's round as well. Question from Ryan Reeves is, what is your opinion on different presentation platforms like Prezi or making your PowerPoint have movement for these meetings? It's a good question. We typically, the default is PowerPoint, static, slide-based, text-based with some images. And typically those go pretty well because they work. The more sophisticated and complicated the program is you're using, or the more unusual the program is you're using to present slides, the more animations, the more internet connectivity you need, the more likely it is that the presentation is not going to work when it comes down to the crunch. And obviously that's not an ideal situation to be in. You should be able to give your presentation even if you haven't got slides behind you, but it's nice to have the materials that you expect to have as your platform. So we see a lot of companies that do use Prezi and other similar platforms, companies that integrate video directly into the presentation. And that if they work, those things look impressive and are good, but you should definitely be prepared for them not to work on the day. We meet in rooms with variable Wi-Fi quality on, using laptops and projectors that work half the time. So the more you make it challenging for the technology to support you, the more difficult it will be. But we have seen some companies recently that have used Prezi presentations and have done a great job, particularly on constructing a narrative around the company. And when they do that successfully, they can sail through the pitching process because it's a high quality presentation. Casey asks, are we mean like sometimes you see the guys on Shark Tank? Well, I mean, we've got some fairly opinionated people in the group, so I wouldn't necessarily say we were mean, but we're probably pretty direct in some of the criticisms that we would have of companies. In part, that's deliberately provocative to see how you handle that kind of direct, stressful questioning in front of a group, kind of like a job interview. But for the most part, we're pretty constructive in our criticism and want entrepreneurs to be successful. And so we try to at least temper that meanness with some useful advice as well. Another question from Casey is, what about pitch videos? There seems to be a trend these days to pitch to investors using videos, or do we like to get the standard executive summary and standard pitch deck as well? That again, I think goes to the point of knowing your investor audience. There's definitely some people out there in the wider angel community or venture capital community that say they want a video version of a pitch deck, but they would much rather watch a 5-minute snapshot commercial of a pitch than read an executive summary. Personally, I prefer the other way. I don't watch a lot of internet videos, and I find the amount of content you can provide in a 5-minute video is much less than I can read if I'm reading for 5 minutes a PowerPoint presentation. So my preference is for that personally, and I think that's probably true of most serious investors. But having a slick 5-minute marketing video is certainly helpful for explaining things to a wider audience. The downside of those is they tend to feature a lot of fairly boring prose, fairly simplified statements, fairly generic images that don't really have a lot to do with the business, which can ultimately prove to be more like watching a commercial than really engaging intellectually with a company, and may ultimately hurt you. But see how it goes. If your business is more is better presented through that kind of commercial activity or video pitch activity than nitty-gritty detail, then perhaps that's a solution that you might want to have. Question from Ryan, does a full business plan need to be written out beforehand, or is a lean canvas document all you would need? So we typically ask for just a 1-page executive summary to start with, and then if you get through that very initial screening part of our process, a 10 to 12-page fairly simple slide deck. We are not going to spend the time to read 50 pages of fully written out business plan. So for us, that's not a requirement of being part of our process. And actually, if you led with that in your introductory email to us and send us a 50-page business plan, we'd probably be more inclined to just delete that email than engage with you. It's a sales process. And when you start a sales conversation with a potential customer, then you don't start by dumping all the information you've got on them. You start by getting them excited about some fairly easy to understand concepts, and then reel them in once they're on the hook from there. The only caveat to that is I think it's very helpful for an entrepreneur to go through the process of writing a detailed business plan, because it makes you think in detail, and it makes you figure out the best way to articulate your business and the various aspects of it in a way that just writing a 1-page executive summary probably doesn't, which sets you up further down the line for when people are doing thorough due diligence on your company to be able to answer those diligence questions a bit more effectively than you would have done if you hadn't thought about that in the past. But to lead as part of the sales process of your company with a business plan, we strongly discourage that. Well, I think I've been through all the questions that are on the Q&A list there. So I'll give you guys a couple of minutes to think about some other potential questions if you have any. There's a couple more coming in, so I'll try to navigate to those. Question from Michael, how many different investor groups do you guys have in South Carolina? So we have 8 groups that meet in person every month, and we have 2 funds that invest alongside those groups, or a hybrid of the 2. That involves about 250 different individual investors. getting around all of those groups to pitch is a challenge. A couple of road trips around the upstate, around the coastal area of South Carolina is necessary to go and get in front of all those groups, for which we hope we have a fairly efficient process for doing that. But you still have to do it. In some ways, having to go to various different locations to do those pitches is helpful. By the time you've done your sixth presentation of your company, you're much better than the first time you pitch it. But we do require that. And if you compare that to having to go and find 250 individual investors to go and pitch to, that's a considerably more efficient process for addressing those investors than 250 cups of coffee in Starbucks with those investors. So 250 in 8 groups and 2 funds is the short answer, Michael. Question from Casey: what kind of involvement do you have in the operations of the business after you invest? So we're investors in the business. We're not operators of the business. We're backing a management team to go and execute the business plan they tell us that they can execute. So at the very simple level, no involvement in the business at all, at the operational level, unless there's a compelling reason and a mutual agreement that we should do that in some way. And there are various ways that we sort of do that, but we never get to the point of actually being the COO or the operations director of a business. And the ways that we actually do get involved are at a formal level on the board. So typically when you're raising a large sum of money from institutional investors like ours, you have an established formal board of directors, and we typically take a seat or 2 on that board, and so see all aspects of the business from the board level. We typically find that entrepreneurs like to have a good cohort of mentors, and they can get those from anywhere, but we have 250 very successful business leaders in our group, so we have a nice population of potential mentors to draw from. And so occasionally some of our investors will get involved in that kind of activity. The most proactive of our portfolio companies come and ask us for help. They ask the people that run these groups, they ask the individual angel investors directly for ways that we can be involved to help them. The most straightforward of those is typically on sales. When you're a small team of entrepreneurs, you typically don't have tons of connections in the space that you're trying to sell into. And these 250 people in our group probably have some decent connections to get you into the companies that you might want to be in front of. And the more proactive you are about doing that, the better. We have one company that has a Google document that we have circulated around our investor group with a list of all the people they would like to talk to, and a way for investors to put into that document other suggestions of people they can talk to and contacts they can make. And hopefully that will increase the speed in which they can scale that business on the sales side. So we get involved in a variety of different ways, not operationally, but to the extent that we can be helpful in the business and therefore help us make a better return on our investment, we are more than happy to try to do that. Casey's next question is how long does the process of pitching take, or the process of raising funds take? So for our group, if everything goes according to plan, it could take 2 months from start to finish to go through our pitching and screening and diligence process and ultimately get funded. That sounds like a long time. That's actually a pretty efficient fundraising timetable, and most people are raising money for a much longer periods than that. And as I said at the beginning, that's if everything goes according to plan. So if all the diligence documents are there, if you approach us at the right time in our screening cycle, and if nothing gets in the way of making the investment at some point. So that's how long the process takes. Delving down into some of the other bits, particularly on the pitching process. So our longest and most involved pitching is 35 minutes. 20 minutes of formal pitch and 15 of Q&A, and that's when you're pitching to the 50 members of our largest groups in person. So that's a fairly short amount of time to convey the complexity, but also the attractions of your business, which is why it's very hard to do a great job of that. And most of the time, people don't do as good a job of that as they would like. They find that after talking for 25 minutes, they've covered barely half of what they want to say. So that's part of the reason for this workshop, to help you realize that up front. The time goes by very quickly, and days of preparation on your PowerPoint lead to 30 minutes of pitching that can easily get out of hand or get away from you if you're not practiced thoroughly. So that's the reason for this kind of workshop. I'm just editing my question queue. I know there's a few in there that that I haven't answered. Let me try this one from Thomas Riley. Is it possible to shadow an angel investor, or are there any live videos on YouTube? Shark Tank is not average. Shark Tank is not average, that's true. Well, typically we don't allow videos of the pitches that our groups see to be public, and there are various regulatory reasons for that. Most of the companies that are pitching to us are doing it under the SEC rules. The rules are called 506B. It means you can only do that to people you already know. So you can only raise money from people you already know, or groups like ours where there's some connection between the leaders of the group and the investors, and so on. So we can't put the videos of those online publicly so that everybody can view them, because that will put them under a different fundraising regime that they don't necessarily want to be under. So it's hard to see good pitches of companies that are raising money. It is possible to come to our group. We don't let lots of people that aren't members of our group participate in the groups. But if you wanted to come along and watch a meeting or a couple of pitches during a meeting, we'd be happy to try to facilitate that for you. The format of Shark Tank is obviously not the same as we're talking about here. But there are, if you Google out there, other companies raising money publicly, you might be able to find some of their videos too if they're doing that. If you would like to come to an angel meeting, particularly if you want to be an investor, but even as an entrepreneur who wants to get a little bit of an inside view of what happens, then feel free to get in touch with us. You can contact us through our website, and we'll be happy to facilitate that. Thomas has another question. Is it appropriate to ask to contact companies that the investor has invested in the past to see how the experience went? Yeah, it is. It's not just appropriate. I think it's good practice for the entrepreneur. We as investors do a lot of due diligence on you as the entrepreneur and the business that you're sending to us. You should do that diligence on us, and we won't be offended by it at all. And in fact, we'll probably be pretty impressed by it. You should do it in a subtle and polite way. Ask permission. Don't do it behind their back. Don't be disruptive. But in the same way that we're going to check your references when you give us those, you should be checking our references. And that's true of angel groups. It's true of individual entrepreneurs too, or individual investors too, although they might not necessarily realize that. But it's absolutely, you're going to be partnering with this investor or this group of investors for a long time. You want to make sure that they are as attractive to you as you are to them. And if they're not, then you want to find a different investor. It also will help you during the process of trying to figure out who your most likely investors are, to figure out who those companies that they've invested in the past were. So throughout that whole process, from start figuring out who the investors are to actually deciding whether you want to take their money, absolutely do your due diligence on the investors as much as we do that on you. I think that, oh, here we go, there's one more. Here's Ryan. Do you require that the company not be speaking with other funding groups at the time of speaking with you all? No, we don't. And in fact, quite the opposite. We encourage entrepreneurs to talk to as many people as they can to raise the money that they need to do that. For the most part, it's hard to raise the full round that you're trying to raise from one source of investors. If you're trying to raise 800,000, for example, it's not all going to be from us. So in that kind of situation, we would absolutely want you to be talking to people right at the very beginning to fill up the 300,000 that we can't invest because we invest 500. The more options you have, the better for you. And our goal is obviously to make money on our investments, but it's also to make sure that the companies that we're engaging with are being successful, so that they can make money, so that their entrepreneurs can cash in that money and become angel investors themselves, and generate jobs and wealth for the community we all operate in. So our goal is to get more companies funded total, and so we don't ever get in a position where we restrict a company from talking to as many people as they can to raise money. There's some more questions gone into the pot here, I think. Thomas asks, will there be more of these Q&A videos in the future? This is very helpful. Well, great. You wish you'd been told in advance to prepare questions. There's no formality to this, so if you come up with questions now, no matter how wacky, I'm happy to answer them. We'll try to do more of these Q&A videos if people like them. They're pretty short and painless, so we'll be very happy to do more of those in the future. We also do in-person seminars, brown bag lunch and learn seminars on various topics: pitching, deal terms, how to value your early stage startup, how to be a good board member, lots of different educational subjects that we try to present. There are a lot of sources for that kind of activity. I don't think there's another forum quite like this that does Q&A in this way. And it's hard to scale this if we're just meeting people in coffee shops. So this is our attempt to try and get the word out and answer the questions that people actually want in a more scaled up way. So we will do more. We'll try to publicize it a bit better than we publicize this one. But we'd love for you to participate in those when we come to do those. I'll answer a couple of the nice questions in the queue, thanking us for doing these. Thank you, Ryan. Appreciate your questions. Hope that you got some value out of the session. Likewise, Casey, thank you for all of your questions too. Oh, there's some more coming in. So I'm happy to keep doing this for as long as people have questions. So keep throwing them in there if you like. Another question from Ryan. Is there a time frame that companies normally try to approach investors? 2 years in business, 3 years? Well, again, it depends on the kind of investors you're talking about. If you're talking about a bank or an SBA loan from a bank, then you need to be in business for 2 years before they'll even talk to you. If you're applying for an SBIR grant from the government, you don't have to be in business for very long at all to apply for that kind of grant. The companies that we typically look at, there's no set time frame they must have been in business. There are more milestones that we like to see them have achieved before we really want to spend a lot of time with them. Our group is typically interested in companies that have some revenue, not a lot, not profitable, not hundreds of customers, but at least a few people that have proven that they will buy this product or service. And that can take 2 years if it takes a long time to develop that product. It can take 2 weeks if it's something that is being built because then the entrepreneur knows there's some customers that are going to buy this and has that all kind of lined up ahead of time. So it doesn't matter how long you've been in business. What matters is, have you done what you need to have done to attract that kind of investor that you're talking to? The other question is, how long, or kind of a related question is, how long do you have to prepare for the fundraising? And again, that depends on the kind of investor you're talking to and how well prepared you are kind of organizationally in your company. The average time for a venture capital round to be funded from start to finish is more than a year, I think, at this point. That's obviously a bit later stage and a bit more professionalized in terms of, or established in terms of asset class. But you need to prepare in advance for fundraising. If you need money 2 weeks from now, then you've left it too late to get even angel money, which takes typically 2 months or takes at least 2 months to get going. So prepare in advance, which obviously you can start doing that even before you're ready to actually take the money. But prepare in advance and then try to align the time frame of your fundraising needs with the time you're going to have hit the milestones that you need to have done to attract that kind of money. Great. Well, I think that answers everybody's questions. Casey says, thanks to Crowder. Crowder is great, by the way. Yeah, thank you to the Crowder team for helping me figure out the technology to make this work. I'd encourage people that are watching this to see if this might be a way to use a different forum to get their Facebook audience engaged, or whoever else they've got interested in their company engaged in a more direct way with what they're doing. You can use this, I think, as a for-profit company too to help sell. You could even use this potentially with our angel group to do some Q&A with members of our group if they have follow-up questions during our process. So I would definitely recommend the people to explore the platform and use it if they can. A question coming from Thomas again. If somebody had an electronics technology company, would it be recommended to find an investor in Silicon Valley for higher valuation? Well, possibly. It depends on how complicated the electronics company is. If it's something that only somebody with a deep background in that company would understand the value proposition for, then you probably need to go where those investors are, and there's typically more of those expert investors in any given industry in Silicon Valley or for life sciences in Boston or wherever else it might be. But if it's a company that you can articulate well enough to a general audience that they will get it and they will find it interesting and attractive, then you should try at least the local investment opportunities first, because it's easier to engage with them than it is with folks in Silicon Valley. We've invested in our angel groups in some pretty complicated businesses. We've got a company in North Carolina that makes or that's commercializing some fluorescent dye technology, and the underlying technology complexity of that is pretty high. I wouldn't claim that everybody that's invested in that company understands exactly what the company is doing technologically, but the market potential for it, the way they pitched, the way they demonstrated that this is a commercial proposition, that there are some big names that will buy the technology when it's finished. They presented a lot around the other 80% we were talking about, the business of the pitch that's not just related to the product itself. They presented very well on that, and then you can therefore get investors in some pretty niche technologies, even if they don't necessarily have the deep background in that locally. So try both, see what happens. If you get lots of traction locally, then it's obviously much easier to deal with investors if they're in your backyard. But if you need to get some outside the local geography assistance from some real experts in that field, then try and see if you can do that. I think that's it for the questions. So thanks everybody for asking the question. Thank you also for people who've contributed to it. We will use your contributions to fund the next Venture Carolina educational resource activities. So thank you again for contributing, for asking your questions. If you have people that you think might find this Q&A useful, then you can send them the link to this, the website. The link you use to get on here will be the same for the recorded version. So thank you all again, and if there's anything we can do to answer your questions in person, then contact us, and we would love to do that. So thank you everybody, and have a good day.